Hi, this is Nick. Welcome to Quest. This is part 2 of 3 videos comparing whether or not you should set up as a sole trader or a limited company. Today we're talking about a limited company. So let me just say right off the bat, if your primary concern is risk, if you're worried about the risks you're taking in terms of setting up a new business, then go limited. Because what a limited company, as the name suggests, what it gives you is limited liability. So long as you don't act recklessly or fraudulently or stupidly, then should the company fail, then any debts it's incurred rest with the company. They can't come after you personally. If you've acted inappropriately, then they can. But as long as you don't run up debts that you can't afford to pay, you don't borrow money then go gambling with it, you don't do stupid things, you don't do reckless things, and you act honestly, decently, and try and conduct yourself in the right manner, then the liability stays with the company. Okay, so that's maybe for you the prime reason for starting a limited company. But if we're looking at the difference in tax regimes, then how do taxes on a limited company work? Now I'm going to break this down into 2 sections, okay, because you've got to get your head around the idea that once you set up a limited company, there is the limited company, that is one legal entity, and then there's you, and you're now separate legal entities even if you own the company. So a company up to 300 grand will pay 19% of its profits in tax. That starts straight away, so if its profits for the year are £1, it'll pay 19p. Okay, and that carries on straight through. And you think, okay, that's nice and simple. We're just getting started. Because the thing you've got to do then is you've got to get the money out of the company. And there's really only 2 ways in which you can take money out of a company. You can put it through payroll. So you set up a payroll system, put yourself on as an employee and pay yourself that way. Or, because you're the shareholder, you can also take out dividends. If you put yourself on as an employee, then typically what we'd suggest is take that up to 8164 per year. Right? Funny number, I know, but it's to do with national insurance thresholds. Below that figure, you won't pay any tax. You won't pay any tax. You won't pay any national insurance either. After that figure, if it's just you in the company, then you'll start paying national insurance, well, 2 types of national insurance. You pay employees' national insurance at 12% and employers' national insurance at 13.8%. So in other words, you're paying 25.8% in national insurance. And because that's higher than the rate of corporation tax, it's not worth doing. So if it's just you, payroll up to 8164. After, if you have an employee, if there's somebody else on the payroll with you, you get an exemption on the employer's national insurance for the first 3 grand. Pardon me. So in that situation, what we normally suggest to people is, in that case, okay, put yourself on payroll and take your income up to £11,500 a year, because that's the rate at which income tax kicks in. Or that's the threshold, I should say. And then beyond that, you're paying income tax at 20% within the basic rate band, which is higher, again, than corporation tax, so not worth doing. And this reference to corporation tax, the reason it's relevant is because anything that goes through payroll gets deducted from your profits of the company, which in turn brings your corporation tax bill down. Okay, so if it goes through payroll, it brings corporation tax down. If it goes through dividends, if you pay yourself through dividends, it doesn't. And therefore, we try and make the most of the fact that most people have a personal allowance, so as to minimise corporation tax. So let's say you've paid yourself up to 8164, and then you go, right, I'm going to take the rest in dividends. How does that work? Well, yes, you can take, if you're the shareholder, you can take dividends out. And as things stand, you can take out 5 grand's worth of dividends and you won't get taxed. That's going to come down to 2,000 next year. But after that 5,000, you're then going to start paying 7.5% on your dividends. All of that will get dealt with as part of your self-assessment every year. So as soon as you start paying yourself dividends, you have to do a self-assessment and need to be paying the tax, if there is any, on that. So as I say, we're going to do another video which actually compares the two and goes through sole trader versus limited company, but this is about how a limited company works. Oh, one last thing, nearly forgot, in terms of when you pay tax for a limited company. If I set up a company today, it's the 12th of October, I pay, in 12 months time my company will have its first year end. 9 months after then I've got to submit my accounts and I've got to submit my corporation tax return and pay it at that time. So that's the time frame. Thanks for listening. Hope this has been a help. Cheers.